hopefully with Sudafed in hand or in mouth or now in my system, I can we'll see. All right. Well, let's talk one or two more cases, and then we'll distribute the exams, talk about that, and then we'll finish up with a little bit more discussion, and hopefully have a productive night. So, the question is with respect to how to compute excess deductions in the O'Brien case, whether or not we should take into account charitable deductions, okay? How do charitable deductions play into excess deductions? So, if you look at the, in this case, the state had gross income of about $879,000, and if you check out the deductions, it had interest, taxes, a whopping charitable deduction, and a few other deductions, not anywhere near the size of the charitable deductions. The charitable deductions combined with the other deductions were north of $940,000. So for the taxpayer, they wanted to claim a deduction equal to that difference, that delta, of $62,000. And the question was, should charitable deductions be used or relied upon in computing the 642H2 deduction? Okay, the 642H deduction. Now look at 642H2. Let's look at it together. I read it to you before, right? I read it to you before. 642H2 says that in the parenthetical it says, other than deductions which are allowed under subsection B or C. But 642C, if you recall, is the charitable deduction, right? So there's a parenthetical that says don't take it into account. In addition to that, there's also the regulations, right? And let me just see if I can quickly find this under 642. Find the regulation, because there's a regulation directly on point that anyway, I can't find the regulation that I want to find as quickly as I wanted to find it. But what's the takeaway from this case? You use the 642, given the statutory language, what does this case hold? Does 642C play any role in computing excess deductions? And the takeaway in this case is it does not. It does not. So the court here upholds the commissioner's view. Okay, the commissioner's view is found in footnote 3 at the bottom of page 225, where the state has a large amount of gross income, and if you notice, you get a deduction for interest, taxes, fees, and miscellaneous expenses. But notice that whopping goose egg for the charitable deduction. So what you'll see here is there is no excess deductions. Often is the case, not always, his trust or estates do not have this magnitude of income in the final year, and you have interest, taxes, fees, and miscellaneous expenses, which are often very large, and therefore it does create excess deductions. But the takeaway in this case is that charitable deductions under 642C should not be part of that equation. They will not help the taxpayer put them on the put them over in a manner that will lead to an excess deduction. All right, so that is the long and short end of this case. So again, this case was decided to get which year. Just remind people, 40 years ago. Nothing much has happened since. I will just point out on page 229, your textbook, as you know, is 10 years old. Item 2 under illustrative material says, according to Treasury Regulation 642H-2A, excess deductions allowable to the beneficiary under 642H2, itemized deductions in the beneficiary's hands. Are they subject to the 2% haircut? Yes. So they will be subject to the 2% haircut. And not only will they be subject, but now under 640, Code Section 67G, the next several years, they're going to be disallowed. Beginning on page 230, you see a case that many of you have seen on many occasions, the so-called Keenan case. You saw this case in your income tax course, right? What does Keenan stand for? Keenan stands for a simple proposition, right? The payment of a specific bequest with appreciated property gives rise to a taxable gain or loss, right? That if you pay off a specific bequest with appreciated property or lost property, that constitutes a sale or exchange, right? Akin to the Crane decision, right? That it constitutes a recognition event. So if I owe, in this case, there was a debt where the executor had to pay the beneficiary a $5 million bequest, and I use appreciated property to satisfy that. The satisfaction of that bequest with appreciated property will give rise to a capital gain or capital loss, as the case may be. Okay. But compare and contrast, I just want to call this to your attention, that if I'm the executor, and by the way, just keep in mind, if someone dies without a will, what happens? The person dies intestate, right? If you die with a will, you die intestate. What happens at the surrogate court if someone dies without a will? What do you petition the surrogate court for? Remember, when someone dies with a will, you petition the court for what? Letters of testamentary, right? Because with the letters of testamentary, you can act in the decedent's name. But suppose the decedent had no will. They died intestate, right? Say again?
You're an administrator?
Administrator, right? That's the technical term. You petition for letters of administration. That's the only difference between the two. My question to you is, if you pay a specific request, you have a specific obligation. But suppose John dies, leaves half of his estate to his wife, half to his son, okay? And the estate has $10 million of appreciated stock. When his executor or administrator satisfies that request, where $5 million is going to his wife, $5 million is going to his children, right? Everyone's got that? Will that trigger, and they use John's executrix or administrator uses appreciated stock, distributes appreciated stock, $5 million to his wife, $5 million to his son, will that trigger a gain? And the answer is no. Why? Because that's not a specific dollar amount. He just said under the terms of his will that his estate gets split equally between his wife and his son, right? He didn't specify that there was a specific number. Everyone understand that? Everyone can distinguish that. There's a difference, clear difference when you have a specific amount that you have to satisfy versus, hey, you're instructed to just split things up between and among the beneficiaries.
Well, that makes sense because when you, like in the stock situation, when you get stepped up basis.
Right, but I mean, David's point is Code Section 1014 applies, but the basis would be stepped up or stepped down as the case may be, equal to fair market value, but it could be 2 or 3 years until the estate makes a distribution. By that time, theoretically, the stock could have doubled in value. So it doesn't mean that the stock hasn't appreciated or gone down in value. But if the executor is not satisfying a specific request, then it's a moot issue. So if you look at page 233, it says in revenue ruling 75-117, a beneficiary was entitled to receive 1/4 of a trust corpus prior to termination of the trust. The trustee proposed to distribute beneficiary appreciated securities equal to the value of 1/4 of the trust corpus. As ruled, the estate would not realize the Keenan gain, right? Because the transfer was a partial distribution of the share of the trust principal rather than a sale exchange because it was not in satisfaction of an obligation of the trust for a definite amount of cash or equivalent in securities. So, what we're going to look at in a moment is when, again, there's a Keenan-like gain, when there's a specific dollar amount involved, which is going to give rise to a gain or loss, or if it's something else where the distribution is made, but it doesn't give rise to a gain or loss. And again, the simplest examples are case one, specific dollar amount, Keenan-type gain, if you distribute appreciated property or depreciated property. The other end of the continuum is where you have residuary clause, and you're just splitting up the remaining assets. So there's no definitive dollar amount. And that dollar amount can fluctuate, right? Because John dies, and half of his estate is going to his wife, half is going to his children, and the estate could be worth $10 million at the time it's terminated, could be worth $3 million, right? Or it could be worth $15 million. So neither his wife nor his son had a claim against the estate for X dollars, a specific amount. So therefore, it's not considered the satisfaction of a specific dollar. Like Keenan, the beneficiary could bang on the table and say, I demand $5 million, right? That can't happen in the case of John's estate, right? So there's no Keenan-like gain. So what we have to do is look at the cases, which we will in a moment, and decide if there's a fixed dollar amount or if it's a request of some other nature. All right, so let's pause for a moment and let's just talk about the exam. And I think the best way to do this is for me to hand this back and then let's just work through some of these problems on the board. Marsh? Jessica's here. Dane, you're here. They're alphabetized, I think, so. Shen. David, you're Karen, you're Lucci. they were respectful. Justin, John. Then there was here, EK here. Then was not here. Javier is not here. We should try to get his number. Julia. Is Carla? Right, okay. Carla is here. Clinty was here. Clinty disappeared. Okay.
Are we keeping them?
Yeah, yeah. The John, oh, there you are. Thing. All right, let's talk about these. Let's make sure we're, because obviously the final exam is going to be similar, but more weighted towards the material we cover in the second half of the course. But it behooves you, both because you're going to practice in this area, and because, again, I may test you on some of this, to make sure that you have a good handle on it. So let's look at these problems. You have a simple trust that has the following receipts and expenditures. Long-term capital gain trustees fees are part of the principal. What is the trust D&I? Okay? So if you didn't get it right, try to take a second just to compute it. See if you got it wrong. D&I is defined, right? Code section 643. And what does it consist of, guys? First, you have to figure out the tentative taxable income, right? So you would take 40,000 dividends, 25,000 in capital gains. We'll get to D&I. $300 worth of exemptions, $2,000 worth of fees. So tentative taxable income is $62,700, right? Everybody agree? Any problem, question, or issue in that? But D&I says we have to make two adjustments here. What are the two adjustments?
Exemption and minus the capital gains.
Add back the exemption and reduce by capital gain, right? So what's D&I? $38,000, right? Remember, this is I put my cards on the table. I pointed out this is a simple trust, okay? So that means it does get the $300 exemption. It must distribute all of his income. under it's 38,000. What's the trust taxable income? We take the tentative taxable income. Oops, 62,700. Right? And you take the lesser of P&I or fiduciary accounting income, and the fiduciary accounting income here is going to be 38,000. Because that's the amount the beneficiary can demand. Right? Because the trustee fees are all applicable principal. And the amount deductible is going to be capped, excuse me, the trustee, even though, let me reframe that, it's a little too much pseudo-fed in my system, is that the trustee can, the beneficiary can demand 40,000 because the trustee fees are all allocable to principal. So under the Principal and Income Act, if they're all allocable to principal, the beneficiary can demand 40,000, but the deduction is capped at D&I, right? That's the ceiling amount that you can deduct. So the deduction here is the tentative taxable income less D&I. So that should be $24,700. Which, by the way, if you never took this course, what do you think, just doing an eyeball calculation, what should the trust be taxable on? Well, what kind of, it's a simple trust. It had capital gains, right guys? At 25,000. Personal exemption at 300. Are we falling off our chairs to know that it's going to be taxed on $24,700? And then, what is the maximum? If it's a simple trust, what two code sections come into play? Code sections 651 and 652, right? 651 and 652, right? And we get a deduction of 38,000 under 651, and we have an inclusion under code section 652 of 38,000, right? That makes sense. We have symmetry here. Harsh, you got that? So question C, question C, 38,000, and what is the character of that income? Dividend income, right? That's the only kind of income that's left. Carla, you got that? Nothing? You know, try not to be tricky. Doesn't help, Mike. So this was designed to be a very straightforward, everyone here should get this kind of problem right. It wasn't, you know, hopefully, I mean, we've seen a lot of variations, but the same thing, there's not even tax-exempt income to throw you off. Question 2. Let's just change it a bit and add $10,000 in tax-exempt income. And now we're going to distribute 50,000 instead of 40,000. So how is that going to change D&I? Well, So here, what's our allowance? Remember, we have $2,000 in trustee commissions. What is going to be allowed and what's going to be disallowed here? What's the numerator and what's the denominator? Karen, you were going to say?
10 over 50.
Why 10 over 50?
10 is the tax exempt over 50 is the total.
10 is the tax exempt, right? Everyone agree? And what's the other income? We have dividend income of 40, tax exempt at 10. 40 plus 10 equals 50. Right, do we include the capital gain? No, because of manufacturer's Hanover, right? The denominator, right, does not include capital gains. So $400 would be disallowed, right? So when we're doing D&I, we have $40,000 worth of dividend income. And we could do what we did before. I guess I did a shorthand version for exam purposes. We're going to do, we don't have to take into account the capital gains with personal exemption. Do we include in D&I tax exempt income? Yes. How much? 9,600, right? That's 10,000 less than $400,000 of expenses allocable to it. How much of the trustee commissions are deductible? Only 1,600, right? 2,000, but 400 was disallowed. So D&I is $48,000. But is D&I the amount that's deductible, guys, or do we have to get modified D&I or IBD? The D&I is 48,000. That was the answer I'm looking for. But ultimately, we're going to have to compute the on Schedule B, right? On the 1041, you compute D&I, but then you have to subtract out the tax exempt income, right? So 38,400 becomes the IDD, income distribution deduction. And that number is going to be important in a moment because the second question B says, what's the trust taxable income? Well, so this is A. That's the the question B, let's go through the computation. So we have 40,000 plus capital gains. And then we subtract out the allowable trustee commissions. Subtract out the personal exemption. So the tentative taxable income is $63,100. That's the tentative taxable income. But then we get to deduct, right, the modify D&I. And is anyone surprised to learn that the trust, once again, is taxable on $24,700, right? Which makes sense, right? That's the capital gains less $300. What is the character of the income the taxpayer is taxable on? Well, you take the $40,000 plus the $1,600 of expenses allocable to it, and it's $38,400 of dividend income. And the tax exempt income is $10,000 plus $400, right? That was allocable to it. And this becomes $9,600 tax exempt income. And together, it adds up to $48,000. Questions?
I have a question for the question one. E&I, I mean the first one, if you say distribution to beneficiary,
Right?
40,000.
Right.
So I just think this number, so use this number as a E&I.
But it isn't.
Yeah, so.
That's fiduciary accounting income.
Okay.
Okay?
I thought this is distributed.
Okay, but that's, you see what the difference is? Think about it, and, we can talk about it. Let's look at question 3. The trust is authorized to make discretionary distributions of income in principal to its two beneficiaries, Roy and Sandy. Separate shares are not required. For the current year, it has D&I and net accounting income of $50,000, all from taxable sources. It distributes $60,000 to Roy and $40,000 to Sandy. So the question is, how much income should each include? This is obviously not meant to be a trick. Remember, D&I will follow, right, with tier 2 distributions, right? These are tier 2. Everyone agree? Not tier 1. And it's going to be in proportion to the size. The larger the distribution, the more the D&I. And here, Roy's getting 60%, Sandy's getting 40%. So Roy gets 60% of $50,000 or $30,000, and Sandy gets 40% of $50,000. Sandy should have $20,000. Okay, everyone, just straight up proportion. Not meant to be tricky. Question 4. Refer to problem 3. How would your answer change if the trust instrument required $10,000 per year be distributed to Sandy, right? That's a tier 1 distribution, right? It's required distribution. right? And the trustee also made discretionary distributions to Roy, 60,000 and 30,000 to Sandy. And that means whatever the tier 2, whatever remains, Roy's going to get 2/3, Sandy's going to get 1/3 of the remaining 40. So if you do the numbers, you'll see that first Sandy gets 10, and then she gets 1/3 of the remaining 40. And she'll end up getting allocated to her total of $23,333. Roy's going to get 2/3 of 40,000, or $26,667. That's it. Everyone got that? Question 5. The Trotter Trust has receipts and expenditures listed below for the current year. The trustee's fee is charged 1/2 to principal and 1/2 to income. Okay. Why that? That's, again, it could be in the trust instrument, or it could be under the Principal and Income Act. Okay. What is the trust fiduciary accounting income and the maximum amount it can distribute? Assume the trust cannot pay out of principal. So if you're a beneficiary of this trust, what do you include in for fiduciary accounting income purposes? You include 30,000 in dividends, right? You're going to bang your fist on the table and demand 10,000 in tax exempt. Agreed? You're going to demand the rental income. But property taxes, you're going to have to bear the burden. What about the trustee commissions? Well, 1/2 is chargeable to income, 1/2 to principal, right? So the fiduciary accounting income that you can demand is $44,000, right? Everyone on the same page as me? So that's all I was looking for in question 5. Question 6. Refer to problem 5. Assume the trustee must pay out all of his income currently due beneficiary Julia. What is the deductible portion of the trustee's fee? Okay. So here's a simple ratio of what part is allowed and what part is disallowed, right? Because the trustee fee again is $2,000. You guys you're used to numerators and denominators, right? So the numerator here is what's the numerator here, guys? 10,000, right? That's the tax exempt income. What's the denominator? 46,000, right? That's the dividends, tax exempt, and rental income, right? There's no capital gains, right? Times 2,000. So the portion which is disallowed is $435. which means 1,565 allowed. Everyone got that? Again, we've gone through these numerator and denominator, nothing tricky.
I use 45 in because the rental tax, so I can use instead of 46.
You're supposed to use the gross number, not the net. That threw you off, obviously.
I need to.
I see that.
But we never used a net number.
The property tax.
But this is an option, right? You can use.
There's no option. You're supposed to use the gross number. Because the tax exempt number is not a net number either. It's always gross. Okay, so given that, let's compute D and I together. Let's the tentative taxable income. We take 30,000 in dividends. We have $6,000 of rental income. We have property taxes of 1,000 that we get to deduct. And the trustee fees, we're only allowed $1,565. Personal exemption, 300. So before the distribution deduction, or the tentative taxable income is $33,135. What's D&I? What do you do for D&I with respect to that number? Add back. What do you add back?
300
Add back 300 plus what?
plus,
The tax exempt.
yeah,
How much is the tax exempt that we will add back?
10,000.
well, no,
Not the
10,000
10.
minus the.
Oh, minus
the
Yeah.
300, yeah, 400 and, yeah.
So it's $9,565. So D&I here, guys, is equal to 43,000. What's the income distribution deduction? Say again, anything?
No, I don't know.
What do you do to get the income? In other words, this is D&I.
Oh, you subtract the taxable,
Subtract what?
the tax exempt,
You subtract back out this
Yeah.
number.
yeah.
So the income distribution deduction becomes 33,435. So this is the answer to C, which was the D&I, and then question D says, what is the trust taxable income? tentative taxable income. And it's going to distribute out all of its income. So, we could go through this, and we just make this. You take the dividend income plus rental income minus property taxes minus the trustee commissions, that portion which is allowable. And now we get a distribution deduction. This is the IDD. This is the allowable distribution deduction. Oops. Plus personal exemption. And not surprisingly, when you do this all together, not going to surprise anyone here. There's no capital gains, simple trust. So that the exemption here is going to be minus $300. I mean the taxable income. Sure.
So, the E&I is 43,000, right?
Yeah.
So I have 43,000, but then you circled in red the first zero.
What did I do?
Circled in red the first zero.
I'll take a look. I don't think I marked it wrong. For whatever reason, I just circled it.
Oh, okay.
Okay, unless in certain instances, like some of your answers I didn't think were as crisp as they should be. And instead of taking off points, I just circled it. Okay, so that's not me taking off points, that's me saying there should be, I don't know in your particular case, but if I just circled it, just means something's a little bit off.
43, some other number, because you circled just that one number, okay.
All right.
Okay.
All right, so look, your exam scores has both this and the multiple choice. If you guys, anyone wants to, before class, in the upcoming weeks, stop by, we can talk about your multiple choice. I'm not expecting people to get 100 on the test. I know, this is tough, and in this case, ping, if you get one, part wrong, it can throw off, and it's very hard for me to know. I just use 1 point, like, for each response, so it's hard to give partial credit. I don't know, so, I try to, how do I say, understand where you're coming from. I think you guys know, if you, now, without the exam pressure, it's always easier to see things, but that I'm not looking to trick anyone. These are meant to be very straightforward things like you've seen before, type of thing. So try to look through this. If you have questions or issues, or you don't understand something, let me know. Again, for the final exam, maybe you'll see 1 or 2 variations of this, but nothing harder than this. If anything, easier than here. But you should just know how to compute these simple, how do you compute tentative taxable income, D&I, taxable income, know about the fraction. It's gross numbers, never net numbers. We've never done a net number before. And just like I keep getting back to, I think it's on page 56, 57 of your textbook, where the authors go through manufacturer's Hanover. Can you do those, can you follow along with that? And can you look at a 1041? Because these numbers end up on Schedule B, right? The front page of the 1041 in Schedule B. Can you look at these numbers, see where they belong? I'm not going to ask you on the final exam either to complete a form 1041, but that's it. These simple numbers end up on the return. The computer will do, the computer is apt to do this for you. I asked you to do it, but not looking to make it complicated. So, questions or issues about this, guys? Concerns?
How do you see our overall grade for like the exam?
Well, you have a combination of both. There's two numbers there. It should be on the upper right-hand side that gives you the multiple choice and then the I'll call it the essay portion.
Is that out of 100 or is that out
No. I forget, I don't have the multiple choice in front of me. I think there was like 38 and the essay portion, I think we were 24, so, I mean, it was like at a 60, I'll make it up, I don't know. Okay. Something like that. Go ahead, John.
So the top numbers?
The multiple choice,
Okay, and the bottom numbers?
this,
This, okay.
okay? I don't have a grade here, you know, again, the final exam will have more points than this, so if you are concerned, just do more on the final exam because it's gonna be more heavily weighted than this. And again, I encourage you to consider buying that nutshell book. There's not too many other resources for this course. Unlike the income tax course or partnership tax or corporate tax, there's like 20 different study guides. This course, unfortunately, guys, has a real lack of study guides. That's just unfortunately a reality. There's not too many study guides out there that are available. All right, so you can Google it, but you'll see when you Google it, unless I'm missing something, there's not too many study guides when it comes to this course. Other questions, issues? All right. So, well, let me just talk about next class then, because I do owe you some minutes from last class. So, we'll pick up on page 234, and let's just talk about one other code section before we call it a night that's very important, that lends itself to exam questions, multiple choice questions as well. So let me call it to your attention now, and then we'll talk about it during the next class. Let's look at code section 643E. You distribute property. When I say you, a trust or estate distributes property. And we say that it pulls out D&I, right? And a trust or estate doesn't always pull out cash, right? The trust or estate can have real estate, it can have stock, you name it, the trust or estate can own it. And whatever property it owns, ordinarily, let's say it owns Apple stock with a $30 adjusted basis and fair market value of 100. And it distributes out the Apple stock. Everyone have the visual? Distributes out Apple stock with an adjusted basis of 30, fair market value of 100. What is it deemed to distribute out? What is the basis to the beneficiary, and what is the amount of the distribution? And if you look, and the authors of our textbook don't make a big deal of this, but this happens all the time, so it's important. 643E1 says the basis of the property received by a beneficiary in a distribution from an estate or trust shall be the adjusted basis of such property in the hands of the trustee or estate immediately before, adjusted by any gain or loss. Well, often the distribution doesn't give rise to gain or loss. So often the beneficiary is going to take a beneficiary basis equal to the basis the trust or estate had. So if it distributes out the Apple stock, the beneficiary is going to have a basis of 30. And E2 says the amount of the distribution. What's the amount? And notice it's the lesser of the adjusted basis in the hands of the beneficiary or the fair market value of the property. So it's going to be the lesser of these two numbers. It's going to be deemed the amount distributed. Unless there's an election made to recognize gain or loss. Recognize gain. This does not happen too often. In fact, I can't recall any case I've been involved in where the executor or trustee elects to recognize the gain. But theoretically it could happen. So look, we're going to look at Code Section 643 in more detail. And we're going to look at the problems on page 242. Then we're going to start looking at Chapter 4. Look at Chapter 4. What does it start with? What case, guys? Your famous Lucas v. Earl, which should be near and dear to the heart of many of you. Right? Look what's next. Blair v. Commissioner. Elbring v. Horst. Right? There's all these cases that many of you have seen. We'll summarize them at the beginning of next class. And then we will get to page 257, the famous Clifford case. Okay, so do spend a fair amount, even though it's no longer good law, do spend some time reviewing it because we're going to be spending, it sort of sets the groundwork for the grantor trust rules. If you can, there's a fair amount of reading next class. Do try to, I'm not entirely sure how far we'll get, but definitely try to read up to page 292. All right? Because some of the material you will have seen already. I don't know how far we'll get, but if you could, that'd be great. And like I said, I owe you from last class because I did keep you after a few minutes. So I will see everyone here next week on Wednesday. All right? If you have any questions about anything,